With Australia in one of the worst recessions in over 30 years and massive unemployment, many businesses are struggling to find their feet after extensive lockdowns and a drop in consumer confidence. However, with record low interest rates, massive government support and stimulus could now be a right time to buy a property. In today's video, we are going to look at why the Australian property market has been so resilient so far and why some parts of the market are actually booming. When the lockdowns first started, there were a lot of negative and bad headlines about the Australian property market, and many experts and the big four banks were all predicting doom and gloom. Some were even suggesting a drop of up to 40 to 50% in the worst case scenario. It has since been almost half a year. Let's look at how prices are performing. As you can see, the home values fell by around 0.4 to 2.3% from March till June, with Melbourne and Sydney falling more than the other states, and by around 0 to 0.2% in August, with Melbourne being the standout. Now, does that look like a property crash to you? Definitely not. The Australian property market has been very resilient. It has surprised even the most experienced experts. Yes, I understand that a lot of this was due to the government support and stimulus, as well as the bank repayment holidays, and a lot of those are now ending or decreasing. However, there are already talks for further rate cuts by the Reserve Bank of Australia. We could see interest rates drop from 0.25% to 0.1% as early as next month. This comes along with the extension of JobKeeper, which has now been extended till March, as well as the banks now offering further repayment holidays for some of its customers. With all of this information, it seems that the September cliff that many buyers have been waiting for has now been pushed back to at least next year. Furthermore, it seems like all of these government stimulus and support has actually driven up property prices. By going back to the August data, we can see a stabilization of house prices in most capital cities. And if we look at the other states, which I would suggest all investors to do so we can get a better idea of what's going on outside of the Melbourne and Sydney bubble, we can see that the house prices in those cheaper states are actually starting to increase. And if you don't believe me, I will encourage you guys to pick up your phone and call the real estate agents at these cheaper markets, and they'll tell you a very similar story about how the property prices are starting to increase and the increased demand that they're seeing in the last few months. Based on my own experience of talking to real estate agents from the other states, they're all telling me a very similar story. Anything that is less than 400k is pretty much flying off shelves with competing offers and selling very quickly. I recently spoke to an agent in Hobart about a property that was listed for $260,000. The property was sold within 24 hours with 8 competing offers. And that is a trend that we are seeing in most of the cheaper markets. And this will make a lot of sense. With the combination of First Home Buyers Grant, the First Home Loan Deposit Scheme, the Home Builder Scheme, and record low interest rates, as well as the indication that interest rates could drop even further, many first home buyers are finally given a chance to step into the market. So what does all of this mean? Well, first of all, I want to make sure we're looking at all the information that is available to us so we can make the best decision, because you know, buying a property is a pretty big deal. I think the most important issue for us to discuss here is the state of the economy, the overpriced nature of some of Australia's biggest cities, and the unemployment, which is now becoming a massive issue. Let's start by talking about the Australian economy and the unemployment figures. There's absolutely no doubt that the state of the economy is not good right now. We saw the biggest single quarter drop of real GDP in 60 years, with the Australian economy dropping by 7% in the June quarter. The current unemployment rate sits at 6.8%, which doesn't seem like a massive deal due to the extensive lockdowns and business closures. However, this number is highly propped up by the JobKeeper scheme. If the JobKeeper scheme was to be removed, the unemployment figure will skyrocket to possibly 10% or even more. So what does all of this data mean? I think it means that we could definitely see some foreclosures in the near future, especially in Melbourne when all of this stimulus wears off. However, with all the current government support and stimulus programs and the possibility of further government stimulus, will enough demand be generated to absorb these foreclosures? I think the answer is yes. I personally think the government and the RBA will introduce further government stimulus, more interest rate cuts, as well as the possibility of negative interest rates just to keep the market afloat, simply because of the devastation a property crash will cause. We're not talking about a few investors going broke here, we're talking about the whole Aussie economy collapsing, with many industries shutting down and millions of Australians losing everything. If you're still worried about a property crash in Australia, I recently made a video discussing why I don't think the Australian property market will crash. I explained my reasoning behind it based on actual numbers, statistics, as well as macroeconomic factors. So if you want to take a deeper dive into this topic, please feel free to check it out. I'll leave a link below. At the start of the video, we talked about how the Australian banks were predicting a massive drop in house prices across the nation. However, recent releases by the bank have suggested the complete opposite, with CBA and Westpac now reducing their initial estimates and actually predicting a speedy recovery and a potential growth of up to 15% in the next 2 or 3 years. CBA has also provided data to show the increase in new home lending, which saw a 6.4% increase in June and an 8.9% increase in July, which is the biggest increase in 18 years. I think what this data tells us is that most states are starting the road to recovery, and the people within these states are starting to get a sense of normality. And as a result, consumer confidence is returning. Let's ignore Victoria for now and look at the household spending for the rest of Australia. This graph clearly shows an upward trend, with household spending in most states almost back to the normal pre-COVID levels. A similar trend is shown here in this graph, showing the number of unemployment benefit recipients. With the exception of Victoria, the rest of the country are starting to get back to work, and the graph is trending downwards. Okay guys, let's not get ahead of ourselves here. Despite all of this data looking promising, we are still in one of the worst recessions in history. And the possibility of a second or a third wave is not out of the picture until a vaccine is developed. Until a vaccine is developed, we should never stretch ourselves financially or take up loans that we can't afford. In fact, regardless of the economic conditions we're in, we should never use credit irresponsibly. Now let's talk about how the current low interest environment is likely to affect the real estate market. For the first time in a very long time, we are seeing interest rates below 2%, and this downward trend is likely to continue as banks more aggressively cut rates and try to attract new customers. We are also seeing some amazing refinance offers. This offer from St. George Bank offers $4,000 cashback on your refinance, with NAB and CBA also offering $2,000. If you are in a position to refinance, now could be a great time to take up some of those amazing offers and lock in a great deal. With record low interest rates and high competition among the banks, this is likely to lead to an increase in borrowing, which in turn is likely to drive up property prices. When interest rate decreases, our borrowing capacity increases. It means we can now borrow more money with the same amount of income. While this gives us more options and greater opportunities, it also makes it easier for the consumer to overextend themselves financially. So it is important to understand that interest rates will go up in the long term, and we need to be able to afford these higher repayments when the time comes. With that said, this move by the RBA and the banks is likely to lead to upward pressure on the real estate prices, and I believe we will start seeing this in the coming months. Now let's talk about the main drivers for real estate price growth. There are a few main drivers for growth. One of them is of course interest rate, which are at a record low. The second one is money supply, which is at an all-time high, with the government pumping hundreds of billions of dollars into the economy in an attempt to restart the economy. The most interesting one that I want to discuss with you guys is immigration. With our borders closed, many sections of the Australian economy are now struggling. Tourism, education, as well as the apartment markets in Melbourne and Sydney, which service these industries. With our borders closed, we are seeing record high vacancies in those markets. The government now has an extensive amount of vacant apartments in two of the biggest cities in Australia, and a lot of immigration to make up for our extensive border closures. So what does this mean going forward? Based on my research and my personal opinion, the government is likely to ramp up immigration when it is safe to do so. With Australia being one of the most desirable countries in the world, many immigrants from all around the world want to migrate to Australia. So as a result, the process can be quite long. However, with so much excess supply of real estate, a full year of immigration to make up for, as well as the need for skilled and wealthy immigrants to kickstart our economic recovery, I feel like the Australian government is going to increase their intake in the coming years to make up for all of that. As we can see here, in 2018, Australia had the highest number of high net worth individual immigration, beating both the US and Canada, due to a high quality of life, political and economic stability, as well as world-class healthcare. With how well Australia managed the recent outbreak and our incredibly low case numbers, you will likely further increase the desirability of our country. With how resilient the real estate market has been the last year, it could attract renewed interest from foreign investors. All these factors are likely to lead to an increase in immigration, and as a result, drive up real estate prices in the coming years. Okay guys, that was a lot of information. I hope you guys were able to make sense of all of that. I just want to talk about one last thing with you guys, and that is finding the right time to enter the market. Okay guys, let's be honest here. We are not property experts. and it will be almost impossible for us to see where the market will be in 3, 6 or 18 months from now. The property market could be booming again, or it could be in another lockdown. If world-class experts can't accurately predict what's going to happen in the market, how are we expected to time the market perfectly? This is one of the most common mistakes I've seen in real estate. I hear people talk about, oh, I'm going to wait for the market to drop by 50% and I'm going to pick up all of these bargains. That is a great strategy, but what if the market never crashes? And when was the last time we saw Australian house prices crash by more than 30%? And while you're waiting for that crash to happen, you're missing out on a lot of growth. And that growth you're missing out on could eventually price you out of the market. Because we are never going to time the market perfectly, there's no point trying to time it. It is simply better to buy a property and hold on to it over the long term, because we know that it will grow in the long term. Let's use an example here. In the year 2000, the median house price in Melbourne was $160,000. 20 years later, it is now $667,000. If we purchase a house in 2000 for $160,000, even if the house price crashed by 50% tomorrow, we will still be in a much better position than those who were waiting for a crash this whole time. Don't get me wrong here, I'm not telling you to go out and buy a property tomorrow. Things are still pretty bad in Australia and could get even worse, but I'm simply telling you to focus on time in the market instead of timing the market itself. Alright guys, we are almost at the end of the video. It is time to answer the question, is it the right time to buy a property? And the answer to that question really depends on you. Is your job secure? Have you got a good deposit saved? Have you got a good emergency fund? If you got all of those, then maybe it is time to start thinking about buying a property. With that said, that is only my personal opinion based on my research. I'm definitely not a financial advisor, and this is definitely not financial advice. I'm just an Asian guy who makes YouTube videos for fun. But I do encourage you guys to use this as a starting point and start doing your own research and due diligence so you can formulate your personalized investment strategy that works best for you. And that brings us to the end of the video. If you got value out of this video, please do me a favor, hit that like button and subscribe for more content just like this. If you got any questions, leave it in the comment section below and I'll do my best to answer them. And I'll see all of you guys in the next video.